Before we dive in, a quick but important note. I am not a financial advisor, and this presentation is for educational and informational purposes only. The information shared here should not be taken as financial advice. Always consult with a qualified professional before making any investment decisions. Your financial situation is unique, and all investing involves risk. Imagine two friends, Alex and Ben. On the exact same day, they both decide to get serious about their money. They each invest $5,000 into what they're told is a top-rated mutual fund. They feel smart, responsible, like they're finally adults taking control of their future. For the next 5 years, they barely look at their accounts. They just let the money work. 5 years later, they meet for coffee. Alex pulls up his account on his phone, a huge grin on his face. His $5,000 has grown to over $8,000. He's ecstatic. That's the down payment on the new car he's been dreaming of. He made the right move. Then Ben pulls up his account. His face falls. His $5,000 is now $4,700. He lost money. He's confused, angry, and demoralized. He did the same thing as Alex. He invested in a good fund. What went wrong? What went wrong is the single most misunderstood, yet most critical concept in mutual fund investing. It's a mistake that costs everyday Americans, people just like you, billions of dollars in lost gains and missed opportunities every single year. And the crazy part is, it has nothing to do with picking a good fund or a bad fund. Both Alex and Ben invested in excellent funds. The difference, the entire reason one of them is celebrating and the other is crushed, came down to one simple distinction: the difference between a short-term and a long-term mutual fund. This isn't just a story about Alex and Ben. This is a story that plays out in millions of brokerage accounts across the country. And the odds are, if you own a mutual fund right now, you might be Ben and you don't even know it yet. You might be using a tool designed for a 30-year marathon to run a 3-year sprint. Or worse, you're using a sprinter's tool for a marathon, guaranteeing you'll run out of gas before you even see the finish line. The financial industry loves to keep this confusing. They throw around terms, they show you complex charts, they talk about expense ratios and beta and alpha, until your eyes glaze over and you just pick the fund with the most stars next to its name. But we're going to change that right here, right now. By the end of this video, you will have absolute clarity. You will understand the fundamental, non-negotiable difference between short-term and long-term funds. More importantly, you will know with unshakable confidence which type of fund is right for your specific goals. We're not talking about vague, generic advice. We're talking about a framework you can use to decide if you need a fund for that house down payment in 3 years, for your kids' college tuition in 10, or for a comfortable, stress-free retirement in 30. We are going to cut through the noise, demystify the jargon, and give you the power to make the single most important choice in your investment journey. This isn't about becoming a Wall Street guru. This is about not being Ben. It's about making sure your hard-earned money is actually working for the life you want to build. So, what is the core misunderstanding? Most people think long-term investing just means holding on to an investment for a long time. That's only half the story. It's like saying a race car is just a car you drive for a long time. No, a race car is fundamentally built differently than a family minivan. It has a different engine, different tires, a different purpose. One is built for explosive speed over a short distance, the other for safety and reliability over a long haul. You wouldn't take a minivan to the Indy 500, and you wouldn't cram your family into a race car for a cross-country road trip. Mutual funds are exactly the same. They are vehicles, purposefully engineered for a specific kind of journey. A short-term fund is built for capital preservation and modest income. Its engine is made of things like short-term government bonds, corporate debt, and other stable, low-risk assets. Its goal is to not lose your money, to beat inflation, and to be there when you need it in the near future, say 1 to 3 years from now. It's the minivan. It's safe, it's reliable. It'll get you to your destination without any terrifying surprises. A long-term fund, on the other hand, is the race car. It's built for one thing: growth. Its engine is powered by stocks, equities, and other assets that have the potential for massive appreciation over time. Its goal is to harness the power of the market and compound your wealth, turning that $5,000 into $50,000, or even more over decades. But with that high-octane engine comes volatility. The ride is going to be bumpy. There will be terrifying dips and exhilarating climbs. It is absolutely the wrong vehicle if you need your cash back safe and sound next year. Alex's goal was a car in 5 years, a medium-term goal. He likely chose a balanced fund or a growth-oriented fund that fit that timeline. The market performed well, and his race car did what it was supposed to do. Ben's goal was also the car. But he, unknowingly, invested in a fund designed for the short term. Maybe it was a short-term bond fund. It was never, ever designed to produce the kind of growth Alex saw. Its primary job was to not lose money, and in a period of rising interest rates it might have even lost a little bit, just like we saw in his case. He brought a minivan to a street race. He never had a chance. The tragedy is that Ben probably thought he was being safe. And that's the trap. People hear short-term and think safe, and they hear long-term and think risky. But that's the wrong way to look at it. The real risk isn't in the fund itself. The real risk is in the mismatch between the fund and your goal. Using a long-term, all-stock fund for your emergency savings is reckless. But using a short-term, all-bond fund for your retirement account when you're 25 years old is just as disastrous. It's a guaranteed ticket to a future where your money hasn't grown enough to support you. So the first step is to stop thinking about funds as good or bad, safe or risky. You need to start thinking of them as tools. A hammer is not better than a screwdriver. It's just different. The question is, what are you trying to build? Once you know what you're building, once you have defined your financial goal and its timeline, then and only then can you pick the right tool for the job. Over the course of this presentation, we are going to open up the toolbox. We're going to examine these tools side by side. We'll look under the hood of a typical short-term fund, breaking down exactly what's inside, who it's designed for, and the hidden dangers most people ignore. Then we'll do the same for the long-term giants, the wealth creation machines that have built fortunes for patient investors. We'll explore the specific types of funds within each category, from ultra-short bond funds to aggressive growth stock funds. And by the time we're done, you won't need to rely on a star rating or a slick advertisement. You'll have a clear, logical system for matching your life goals to the right investment vehicle, ensuring you're always in the driver's seat of your financial future. Let's start by shattering the biggest myth of all: what the word term actually means when it comes to the assets inside the fund. It's not about how long you, the investor, plan to hold the fund. That's the single most common and most dangerous misunderstanding in the entire world of investing. When you see a fund labeled short-term, it's not a recommendation that you should only own it for a short time. And a long-term fund isn't one you're locked into for decades. Instead, the term refers to the lifespan of the assets inside the fund. Think of a mutual fund as a basket. The fund manager fills that basket with dozens, hundreds, or even thousands of individual investments. In the world of funds, these investments are typically one of two things: stocks or bonds. A stock, as you probably know, is a tiny piece of ownership in a company like Apple or Ford. It has no expiration date. You can own it forever. A bond, on the other hand, is much simpler. It's just a loan. It's an IOU. When you buy a bond, you are lending money to a government or a corporation. In return, they promise to pay you regular interest, and then, on a specific future date, they promise to pay your original loan back in full. That specific future date is the key. It's called the maturity date. And that is what the word term is all about. A short-term mutual fund is a basket filled with loans, with bonds, that are due to be paid back very soon. We're talking about investments with maturity dates of just a few months to maybe a couple of years. These are things like U.S. Treasury bills or T-bills, which are basically super safe short-term loans to the U.S. government. They also hold things like commercial paper, which are short-term loans to highly rated, stable corporations. The entire goal of a short-term fund is not to make you rich. It's not about growth. Its mission is twofold: capital preservation and liquidity. Capital preservation simply means keeping your original investment safe, not losing money. Liquidity means you can get your cash back quickly and easily, without taking a big hit. The best way to think about a short-term fund is as a parking garage for your cash. You wouldn't park your car in a garage for 10 years expecting it to magically transform into a brand new Ferrari. That's not what a garage is for. You park it there because you know it will be safe, protected from the elements, and ready for you to drive away the moment you need it. You pay a small fee for that safety and convenience. A short-term fund is the exact same concept for your money. It's a safe, stable place to park cash that you know you're going to need in the near future. And instead of you paying a fee, it pays you a small amount of interest for the privilege of parking there. Because these funds only hold ultra-safe loans that are being paid back very soon, the risk is incredibly low. There's very little time for the borrower, like the US government, to run into trouble. There's very little time for major economic shifts to derail things. But with low risk always comes low reward. The returns on these funds are modest. They'll typically yield a little more than a high-yield savings account, but they will never, ever deliver the explosive growth you see in the stock market. You're not trying to build a skyscraper here. You're just building a solid foundation. So who is this for? Let's talk about Sarah. Sarah is 28, and she's been saving for a down payment on her first condo. She's got $40,000 saved up. A huge accomplishment. Her goal is to buy a place within the next 18 months. Now, where should Sarah keep that 40 grand? If she puts it in a checking account, it's earning zero interest, and inflation is silently eating away at its buying power every single day. If she puts it in the stock market, she's taking a massive gamble. A sudden market downturn could slash her down payment by 10 or 20% right when she's ready to make an offer. That would be devastating. For Sarah, a short-term bond fund is the perfect tool for the job. Her $40,000 is parked in a safe, stable vehicle, protected from market volatility. It's earning a little bit of interest to help offset inflation, and when she finds the perfect condo next year, she can sell her shares and get her cash out quickly. It's the parking garage for her down payment. Now let's flip the coin and look at the other side. Long-term funds. If short-term funds are parking garages, long-term funds are like planting a forest. The entire philosophy is different. A long-term fund is a basket filled with assets that are designed for growth over many, many years, even decades. This primarily means one thing: stocks. Remember, stocks are ownership in businesses, and they have no maturity date. But this category also includes long-term bonds, loans made to governments and corporations that won't be paid back for 10, 20, or even 30 years. The goal here isn't preservation, it's appreciation. It's about turning your initial investment into a much, much larger sum over time. You are sacrificing short-term safety for the potential of long-term growth. You don't plant an oak sapling and expect to have a towering, shade-giving tree by next summer. You plant it, you nurture it, and you give it decades to grow. Along the way, there will be droughts, storms, and harsh winters. Those are the market crashes and recessions. Some branches might break. The tree might even look like it's dying for a while. But with enough time, it grows into something strong, massive, and incredibly valuable. This brings us to the risk and reward. The risk in long-term funds is high, especially in the short run. The value of the stock market can be incredibly volatile. It can drop 10% in a week or 30% in a year. There are no guarantees. But this is the price of admission for higher potential returns. Over long stretches of time, the U.S. stock market has historically delivered average annual returns that are multiples higher than short-term funds. That's because, over the long run, well-run companies tend to innovate, grow their profits, and become more valuable. As a shareholder, you get to participate in that success. So, who needs to plant a forest? Let's meet Mike. Mike is 32. He has a good job and is starting to think seriously about retirement, which is a good 30 to 35 years away. He's putting away a few $100s from every paycheck into his 401k. If Mike put his retirement money into a safe short-term fund, it would be one of the biggest financial mistakes of his life. Yes, his money would be protected from market crashes, but it would also be protected from growth. Over 35 years, the slow, corrosive power of inflation would likely leave him with less real-world buying power than he started with. He would arrive at retirement with a nest egg that's completely inadequate. Mike needs growth. He needs the power of the stock market. Because his time horizon is so long, he can afford to ignore the short-term volatility. A 20% market drop when he's 35 is just a temporary setback. In fact, it's a great opportunity for him to buy more shares at a discount. He has decades for the market to recover and continue its upward climb. He has time for his oak tree to weather the storms and grow tall. He is using a long-term tool for a long-term goal. So you see, it's never about asking, which is better, a short-term or a long-term fund? That's like asking, which is better, a hammer or a saw? They are both essential tools, but they are designed for completely different jobs. You use a saw to cut wood and a hammer to drive nails. You use a short-term fund to protect money you need soon. You use a long-term fund to grow money you won't touch for years. The most critical skill is knowing which tool to pull out of the toolbox for the specific financial job you're trying to accomplish. The timeline of your goal dictates the term of your fund. Down payment in 1 year? Short-term. Retirement in 30 years? Long-term. It's that simple, and yet, getting it wrong is the root cause of so many financial heartaches. But here's where it gets more complicated. What happens when the supposedly safe short-term investment suddenly loses value? Or when the risks in your long-term funds are not at all what you think they are? Because beneath the surface of both these categories lie hidden dangers that can catch even savvy investors completely by surprise. And that's exactly what we need to uncover next. Let's start with your short-term funds. The ones you think of as safe. The money for a house down payment, a new car, or that emergency fund you pray you'll never need. The common wisdom is that the risk here is minimal. You put your money in, it earns a tiny bit of interest, and it's there when you need it. The biggest danger most people assume is that the fund might lose a fraction of a percent in a weird market fluctuation. But that's not the real danger. Not even close. The most lethal risk in a short-term fund is completely invisible. It's a silent killer of wealth that doesn't show up on your monthly statement. It's called inflation. Now I know what you're thinking. Inflation? That's boring. I hear about it on the news. But you have to understand it not as a news headline, but as a pickpocket who is stealing from you every single day. Imagine you have $20,000 saved for a down payment on a house. You put it in a high-yield savings account or a short-term bond fund. You're being responsible. Over the year, you earn a respectable 2% interest. Your statement says you now have $20,000 for $100. You made money. You feel good. But during that same year, the price of the house you wanted to buy went up by 7%. Your $20,000 down payment target is now $21,400. So while your statement says you gained $400, you're now $1,000 further away from your goal than when you started. You were running on a treadmill, but the treadmill was secretly pointed downhill. You were moving forward, but you were losing ground. This is the insidious nature of inflation risk in so-called safe investments. You don't see a negative number on your statement. You don't get a warning bell. You just quietly lose purchasing power. Your dollars are still there, they just buy less. It's like a termite infestation in the foundation of your financial house. By the time you notice the damage, it's already extensive. For any goal that's more than a few months away, a short-term fund isn't just a parking spot for your cash. It can be a slow-motion shredder for your dreams. But there's a second related risk here that's just as dangerous: opportunity cost. Every dollar you keep in a low-growth, short-term fund is a dollar that isn't working hard for you somewhere else. We're so terrified of losing money that we forget to think about the money we're failing to gain. Let's say you have money set aside for a goal that's 5 years away. You think, 5 years isn't long-term, I'll keep it safe. So you put it in a fund earning 2%. A friend, meanwhile, puts the same amount into a conservative long-term fund that averages 7%. After 5 years, the difference might not seem catastrophic. But what if that 5-year goal gets pushed back to 10 years? Or 15? Life happens. The magic of compounding interest means that small differences in returns become gigantic canyons of wealth over time. That 5% difference between your safe fund and their growth fund is the difference between your money doubling in 36 years versus doubling in just over 10 years. By playing it too safe for too long, you are forfeiting decades of financial freedom. The opportunity cost isn't just a number on a spreadsheet. It's the vacation you don't take, the retirement you have to delay, the financial stress you have to endure because your army of dollar bills was sitting in the barracks instead of out on the battlefield, fighting for you. So the hidden dangers in short-term funds are the slow, silent erosion of inflation and the massive missed potential of opportunity cost. They lull you into a false sense of security, while your goals quietly drift further and further out of reach. Okay, you might be thinking, I get it. Being too safe is risky. The answer is obvious. Embrace the risk of long-term funds for my long-term goals, like retirement. And you're right, that is the conventional wisdom. But the risks lurking in your 401k or your IRA are far more complex and far more terrifying than a simple number on a screen. The obvious risk, the one everyone talks about, is volatility. The market goes up, the market goes down. You see the headlines. Dow plummets 1,000 points. It's scary. But here's the secret. For a true long-term investor, volatility itself is not the real risk. A market crash is not the risk. The real risk is you. It's your reaction to the crash. The greatest danger to your long-term portfolio is the face you see in the mirror every morning. It's panic. Think back to March of 2020. The world was shutting down, uncertainty was everywhere, and the stock market was in a freefall. It felt like the end of the financial world. Millions of people, terrified of losing everything, sold their long-term investments. They sold at the bottom. They turned a temporary, on-paper loss into a permanent, catastrophic, real-world loss. Meanwhile, the people who understood the true nature of long-term investing did nothing. Or even better, they kept buying. And within months, The market not only recovered but soared to new highs. The people who sold locked in their losses forever. The people who held on saw their portfolios become larger than ever before. The risk wasn't the virus or the market drop. It was the emotional human instinct to run from danger at the exact worst moment. This is the demon every long-term investor has to conquer. But let's say you have nerves of steel. You can ride out any storm. You're still not safe, because there's a far more technical and far more destructive risk that most people have never even heard of. It's called sequence of returns risk. This sounds complicated, but the idea is simple and horrifying. The order in which you receive your investment returns matters immensely, especially when you start withdrawing money in retirement. Let's imagine two identical investors, both with $1 million portfolio. Investor A retires, and in his first year, the market crashes 30%. He has to sell his stocks at a massive discount just to pay for his living expenses. He's selling more shares to get the same amount of cash, permanently depleting his portfolio. It may never recover. Investor B retires, and in his first year, the market soars 30%. He sells a tiny number of shares to fund his lifestyle, leaving the vast majority of his portfolio to keep growing. 10 years later, even if both investors have the exact same average return over the decade, Investor A might be broke, while Investor B is wealthier than when he started. It was the same money, the same average return, but a different sequence. A bad sequence of returns at the start of retirement is like a knockout punch in the first round of a 15-round fight. It's almost impossible to come back from. And finally, there's one more hidden danger, one that preys on our desire for simplicity. It's the risk of diversification. That's not a typo. It's the idea that your diversified long-term fund isn't nearly as diversified as you think. You might own a popular S&P 500 index fund and think you're spread across 500 of America's greatest companies. But because these funds are weighted by market capitalization, a huge portion of your money, sometimes 25 or even 30%, is concentrated in just a handful of mega-sized tech companies. Your financial future isn't resting on the performance of 500 companies. It's resting on the fortunes of Apple, Microsoft, Amazon, and a few others. If that one specific sector hits a rough patch, your entire diversified portfolio takes a massive hit. It's like thinking you've packed a balanced lunch. But when you open the box, you discover it's really just one giant apple and 499 breadcrumbs. This concentration risk creates a massive blind spot for millions of investors who believe they are safe. So let's recap the hidden dangers. In your safe short-term funds, you have the invisible thief of inflation and the ghost of opportunity cost. In your growth long-term funds, you have the emotional demon of panic selling, the mathematical nightmare of sequence risk, and the structural blind spot of overconcentration. These aren't the risks they teach you about in business school. These are the real-world, high-stakes dangers that can derail your entire financial life. Knowing these risks is one thing, but how do you actually build a plan that defends against them? How do you structure your portfolio to protect your down payment from inflation while ensuring your retirement can survive a crash on day one? It requires a framework, a new way of looking at your money, not just in terms of short-term and long-term, but in a much more nuanced, strategic way. It's about matching the right tool to the right job and understanding the true timeline of your goals. And that is precisely what we need to break down next. Let's start by thinking about this like a master craftsman. A skilled carpenter doesn't just have one tool. They don't just have a hammer. They have a 28-ounce framing hammer for driving huge nails into structural beams, and they have a tiny lightweight pin nailer for delicate trim work that you can barely see. Using the wrong one would be disastrous. Imagine trying to build the frame of a house with a tiny trim hammer. It would be impossible. Now imagine using that giant framing hammer to attach a delicate piece of crown molding. You'd shatter it into 1,000,000 pieces. The exact same principle applies to your money. Your financial goals are the different jobs that need to be done, and mutual funds are your tools. Using the wrong fund for the wrong goal can be just as destructive as using the wrong hammer. It can shatter your financial plans. So the single most important question you need to ask isn't, is this a good fund? The question is, what job do I need this money to do for me, and when do I need it done? Let's break down your financial life into 3 distinct time horizons, or what I like to call buckets. The now bucket, the soon bucket, and the later bucket. First, the now bucket. This is money you know you will need or might need within the next 0 to 2 years. This is your emergency fund, the money to cover a surprise medical bill or a sudden job loss. This is the cash you're saving for a down payment on a new car next year. It's the money for the big European vacation you've already booked for 10 months from now. For this bucket, the job is not growth. I want to repeat that because it's the most misunderstood concept in short-term investing. The primary, overwhelming job of the money in your now bucket is capital preservation. It's about ensuring that when you need 100% of that money, 100% of it is there. You cannot afford to take a risk that your $10,000 emergency fund has become $8,000 right when your transmission blows. The return you're looking for here isn't a high interest rate. It's the peace of mind that comes from stability and liquidity. So what tools belong here? This is the exclusive territory of the most conservative short-term funds. We're talking about money market mutual funds. These funds invest in extremely high-quality, ultra-short-term debt like U.S. Treasury bills. Their goal is to maintain a stable net asset value, typically $1 per share. They are designed to be the next best thing to cash in a savings account, often paying a slightly better interest rate, while remaining incredibly liquid. Another tool for this job is an ultra-short-term bond fund. These are a tiny step up in risk from a money market fund, but still incredibly conservative, typically holding debt that matures in less than a year. The potential return is slightly higher, but the focus remains squarely on stability. Putting anything more aggressive than this in your now bucket is like using a chainsaw for surgery. It's the wrong tool and the results will be messy. Next, we have the soon bucket. This is for goals that are roughly 3 to 7 years away. This is a critical and often tricky time frame. This is your down payment for a house you plan to buy in 5 years. It's the seed money for a business you want to launch after you finish your MBA in 4 years. It's the funds for your kids' braces or a major home renovation. With this timeline, the job description changes. You still need a high degree of safety, but you have a little more time to recover from minor market fluctuations. Because of that, you can now afford to take on a little more risk in exchange for a little more potential growth. The goal is to at least beat inflation, so your 5-year-out down payment doesn't lose its purchasing power while it sits there. Pure capital preservation isn't enough. We need some modest growth, but without exposing ourselves to the wild swings of the stock market. The tools for the soon bucket are different. Here we look at short-term bond funds. Unlike their ultra-short-term cousins, these funds might hold bonds with maturities of 1 to 3, or even 1 to 5 years. This introduces a bit more interest rate risk, meaning if rates go up, the value of these bonds can go down temporarily, but it also provides a higher yield. You might also consider a conservative allocation fund, sometimes called a capital preservation fund. These funds hold a mix of assets, but they're heavily weighted towards safety, maybe 70% in bonds and 30% in stable dividend-paying stocks. They're designed to provide a little bit of growth from the stock portion while the bond portion acts as a big, heavy anchor, keeping the fund from swinging too wildly in a storm. Using these tools gives your money a chance to grow, but with guardrails in place to protect against a catastrophic loss that could derail your medium-term goal. Finally, we have the later bucket. This is for any goal that is 8 years away or more likely decades away. This is retirement. This is college savings for your newborn child. This is long-term generational wealth building. For this bucket, the job is completely different. The job is growth. Aggressive, unapologetic, long-term growth. Why? Because your greatest asset here is time. Time is the magic ingredient that smooths out market volatility and unleashes the power of compounding. A 20% market drop when you're 30 years old and 35 years from retirement isn't a disaster. It's a sale. It's a chance for your regular contributions to buy more shares at a lower price. The tools for the later bucket are the ones people most often think about when they hear investing. These are long-term mutual funds, primarily stock funds, also known as equity funds. This includes things like S&P 500 index funds, which buy you a small piece of the 500 largest companies in America. It includes total stock market funds, which give you exposure to the entire U.S. stock market. It can also include international stock funds to diversify across the globe, or more aggressive growth funds that focus on innovative technology or healthcare sectors. These funds will be volatile. They will have years where they go down. But over any 10, 20, or 30-year period in history, the market's trend has been powerfully, undeniably upward. Using a conservative bond fund for your retirement savings when you're 25 is like trying to build that house frame with the pin nailer. You'll make very little progress and you will fail to build anything substantial. Now, here is the billion-dollar mistake that so many people make. They mismatch the tool and the job. They hear about a hot tech fund that's up 40% in the last year, and they think, Wow, I'll put my house down payment money in there. I'll be able to buy an even bigger house in a year. They take money from their now bucket and use a tool from the later bucket. For a while it might even work. But then 6 months before they need to make the down payment, the market hits a rough patch. That hot tech fund drops 30%. Their $50,000 down payment is now $35,000. They are forced to either sell at a massive loss and buy a much smaller home, or postpone their dream of homeownership indefinitely, waiting and praying for the fund to recover. They used a sledgehammer to hang a picture, and they blew a hole right through the wall of their financial future. The opposite mistake is just as damaging but far more subtle. It's the person who is so afraid of risk that they keep their retirement money, their later bucket money, in a money market fund or a short-term bond fund for 40 years. They're so focused on not losing a penny that they don't realize a silent thief is robbing them blind every single day. That thief is inflation. Over 30 or 40 years, the cost of living will multiply. A return that doesn't significantly outpace inflation is, in reality, a negative return. Their money is safe, but their purchasing power is melting away like an ice cube on a summer sidewalk. By the time they retire, their nest egg can't even afford to build the birdhouse, let alone the dream house. They used the delicate trim nailer to frame a house, and the structure they built is too weak to stand. Understanding these 3 buckets now, soon, and later is the foundation of a successful investment strategy. It transforms the conversation from a confusing mess of fund names and market noise into a simple, logical process of matching the right tool to the right job. It ensures you have stability when you need it and growth when you have the time for it. So now that we understand the strategic framework of why we choose a certain type of fund, we have to get tactical. How do you actually look at 2 different short-term bond funds and know which one is right for your soon bucket? How do you look under the hood of a long-term growth fund to see what you're actually buying? That requires learning how to read the label on the box and understanding the secret language of mutual funds, a language filled with terms like expense ratios, turnover, and management fees, all of which can have a massive impact on how much of your money you actually get to keep. Let's start with the biggest one, the silent killer of investment returns. The expense ratio. Think of it like a tiny, almost invisible leak in your car's gas tank. One drop doesn't seem like much. You wouldn't even notice it day to day. But over a long road trip, say your 30-year journey to retirement, that slow, constant drip can leave you with an empty tank, stranded miles from your destination. The expense ratio is an annual fee, expressed as a percentage of your investment. It's automatically deducted from the fund's assets to cover its operating costs. This includes the fund manager's salary, marketing expenses, administrative fees, and all the other boring but necessary costs of running a massive financial operation. Now, you might see a fund with a 1% expense ratio and think, 1%? What's the big deal? That's nothing. And that is precisely what the fund companies want you to think. They want you to see it as a tiny, insignificant number. But it's not. It's a vampire fee. It sucks a percentage of your total investment, year after year after year, regardless of whether the fund made you money or lost you money. The fund manager always gets paid. Let's put this into perspective with some cold, hard numbers. Imagine you invest $10,000. You're comparing 2 different funds that both track the S&P 500, and for our example, let's assume the market gives a hypothetical 7% average annual return over the next 30 years. Fund A is a low-cost index fund with a tiny 0.05% expense ratio. Fund B is an actively managed fund with a seemingly reasonable 1.25% expense ratio. In Fund A, your net return after fees is 6.95% per year. After 30 years, your initial $10,000 would grow to about $75,500. Not bad at all. Now let's look at Fund B. After its 1.25% fee, your net return is only 5.75% per year. That doesn't sound like a huge difference, does it? But let's run the numbers. After 30 years, your $10,000 in Fund B grows to just over $53,000. Let that sink in. You invested in a fund that charged just a little over 1% more per year, and it cost you over $22,000. That's the price of a brand new car. It's a down payment on a house. It's multiple dream vacations. And it vanished into thin air, eaten alive by a fee that looked harmless on paper. This isn't a market loss. This is a guaranteed loss you sign up for on day one. It's the single most reliable predictor of future fund performance. Not the star manager, not the past returns, but the cost. The lower, the better. But the expense ratio is just the monster you can see. There's another, more insidious force at play, and it's called turnover. The turnover rate tells you how often the fund manager is buying and selling the stocks inside the portfolio. A turnover rate of 100% means that, on average, the manager has replaced every single stock in the fund within the last year. A 20% turnover rate means they've held onto their positions for an average of 5 years. Why does this matter? Because high turnover is like a hidden tax on your investment. Every time a manager buys or sells a stock, the fund incurs transaction costs, brokerage commissions, bid-ask spreads. These costs are not included in the expense ratio. They are an additional, invisible drag on your returns. It's like paying for shipping and handling on every single transaction the manager makes on your behalf. A fund with a 200% turnover rate is essentially a day trading operation, and you are footing the bill for every single frantic click of the mouse. But it gets even worse. This is where it gets personal, and it hits your wallet directly at tax time. High turnover has massive tax implications. When a fund sells a stock it has held for more than a year, any profit is considered a long-term capital gain, which is taxed at preferential rates, currently 0%, 15%, or 20% for most people in the US. But when a fund sells a stock it has held for a year or less, that profit is a short-term capital gain. And short-term gains are taxed as ordinary income, the same as your salary, which can be as high as 37%. So imagine this: your hyperactive fund manager with a 150% turnover rate is constantly buying and selling. They rack up a ton of short-term capital gains. At the end of the year, the fund is legally required to distribute those gains to you, the shareholder. And guess what? You get a tax bill for those gains. You have to pay taxes at your highest marginal rate on all that churning the manager did. It's possible for you to get a massive tax bill from your mutual fund, even in a year where your fund's value actually went down. You can literally lose money and still owe taxes, all because the manager was trading too much. This is the critical link between the secret language of funds and our central question of short-term versus long-term investing. Think about it. Which types of funds are likely to have high expense ratios and high turnover? It's the short-term, actively managed funds. The ones that promise to beat the market. The managers of these funds justify their high fees by claiming they have a special skill, a unique insight that allows them to jump in and out of stocks at just the right time. They create a lot of action, a lot of trading, a lot of turnover to make it look like they're earning that fat paycheck. On the other side, you have the classic long-term vehicles like a simple S&P 500 index fund. What's its strategy? To buy the 500 largest companies in the US and, well, that's pretty much it. It holds them. The turnover is incredibly low, often less than 5%, because they only sell a stock when it drops out of the index. And because a computer algorithm is doing most of the work, the expense ratio is dirt cheap. There's no star manager demanding a 7-figure salary. Let's bring this to life with the story of two friends. Let's call them Chris and Sarah, who both start investing $500 a month on the same day. Chris is drawn to the excitement of the Global Tech Opportunities Fund. It has a famous manager, a great 5-year track record, and it's always in the financial news. It also has a 1.5% expense ratio and a 120% turnover rate. Chris feels smart. He feels like he's in on the action. Sarah, on the other hand, does a little research and chooses a boring total stock market index fund. Its expense ratio is 0.04%. Its turnover is 4%. Her friends think she's being too conservative, too simple. There's no exciting story to tell about her investment at dinner parties. For the first few years, Chris's fund has moments of brilliance. It soars when a few of its tech bets pay off. He feels like a genius. Sarah's fund just plods along, tracking the market, earning a steady, unremarkable return. But under the surface, something is happening. Every year, 1.5% of Chris's hard-earned money is vaporized by fees. Every trade his manager makes shaves off another fraction of a percent in hidden costs. And every December, he gets a hefty capital gains distribution, forcing him to write a bigger check to the IRS. Sarah, meanwhile, keeps almost all of her returns. The 0.04% fee is practically a rounding error. Her tax bill from the fund is minimal because there's so little turnover. Flash forward 30 years. Chris looks at his statement. He's done okay. He has a respectable nest egg. But then he talks to Sarah. And he's floored. Despite investing the exact same amount of money over the exact same time period, Sarah's boring fund has left him in the dust. Her balance is hundreds of thousands of dollars larger than his. Chris didn't lose to the market. He lost to fees. He was beaten by turnover. He was defeated by the very complexity and excitement he thought was giving him an edge. His short-term focus, embodied by his choice of a high-cost, high-turnover fund, was a constant headwind, forcing him to run twice as hard just to keep up. Sarah's long-term, low-cost approach was a constant tailwind, gently and relentlessly pushing her toward her goal. This raises a monumental question. If the built-in costs of short-term, active strategies are so crippling, is it even possible for them to win in the long run? Can any manager, no matter how brilliant, consistently overcome the brutal mathematics of fees and taxes? To answer that, we need to step away from abstract theory and look at one of the most famous, and perhaps most one-sided, bets in the history of finance. It's a story that pits the brightest minds on Wall Street against a simple, boring, automated strategy. In 2007, Warren Buffett, the legendary investor from Omaha, issued a public challenge. He wagered $1 million that over a 10-year period, a simple low-cost S&P 500 index fund would outperform any portfolio of hedge funds that an expert could select. Now let's be clear. Hedge funds are supposed to be the absolute pinnacle of active short-term management. They're the special forces of the investing world, run by brilliant managers who use complex strategies to find market inefficiencies. They charge astronomical fees for their supposed genius, often a 2-in-20 structure, meaning a 2% annual management fee on all assets, plus 20% of any profits they generate. The entire premise of their existence is that they can beat the market. So when Buffett made this bet, he was throwing down the gauntlet not just to one person but to the entire philosophy of high-cost active management. The challenge was accepted by a man named Ted Seeds of Protege Partners. Seeds was no fool. He was a highly respected professional in the world of high finance. And he didn't just pick one hedge fund, which would be risky. Instead, he chose 5 different funds of funds. Think about what that means. Each of his 5 chosen funds was itself a portfolio containing dozens of different individual hedge funds. So Seeds' side of the bet was represented by hundreds of the world's most expensive, supposedly smartest money managers. It was the ultimate dream team of active management versus Buffett's single, dirt-cheap index fund. The bet began on January 1, 2008. And almost immediately, it looked like Buffett had made a catastrophic mistake. In 2008, the global financial crisis hit. The stock market imploded. The S&P 500, which Buffett's fund tracked, plummeted by a horrifying 37%. This is the exact scenario where active managers claim they earn their keep. They can sell stocks, move to cash, short the market, and protect investors from the downside. And in that first year, they did. Ted Seeds' portfolio of hedge funds lost money, but they only lost about 24%. They had beaten the index fund by a whopping 13 percentage points. The active managers looked like heroes. The financial press buzzed. Had the old man from Omaha finally lost his touch? But Buffett's argument was never about a single year. It was about the relentless, grinding, inescapable math of costs over a long period. As the markets began their slow, painful recovery in 2009, a different story emerged. The S&P 500 index fund, with its full exposure to the market and its minuscule fees, began to climb. The hedge funds climbed too, but they were running a race with an anchor tied to their leg. Imagine 2 runners. One is the index fund, the other is the hedge fund manager. At the start of every year, the index fund runner starts at the starting line. But the hedge fund runner, because of his 2% management fee, has to start 20 yards behind the starting line. Then, if he actually manages to win the race, the official takes 20% of his prize money. Year after year, he has to be significantly faster than the index fund runner just to end up in the same place. For a year or two, a brilliant runner might overcome that handicap. But over 10 years, the math becomes brutal. By the end of the 10-year bet on December 31, 2017, the results weren't just a victory for Buffett, they were a complete and utter annihilation. The simple, boring Vanguard S&P 500 index fund had delivered an average annual return of 7.1%. The sophisticated, expert-picked portfolio of hedge funds? It returned a pathetic 2.2% per year. Let's put that in dollar terms. $1 million invested in the index fund would have grown to over $1,854,000. The same $1 million invested with the best and brightest of Wall Street would have grown to just $1,220,000. The so-called smart money had been left in the dust. In fact, the result was so lopsided that Ted Seeds publicly conceded defeat in Forbes magazine nearly a year before the bet was even officially over. He admitted that the high fees were an impossible hurdle to overcome. Now you might be thinking, that's hedge funds. They have crazy fees. What does this have to do with my mutual fund? It has everything to do with it. Because a short-term, actively managed mutual fund is playing the exact same game as a hedge fund, just with slightly lower, but still significant costs. The fundamental principle is identical. The manager is making a bet that they can overcome their built-in costs by being smarter than the millions of other smart people who make up the market. The average actively managed stock mutual fund in the US has an expense ratio of around 0.8% to 1%. That might not sound like much, but it's the same handicap. It means your fund manager starts every single year 1% in the hole compared to the market itself. They have to generate 1% of outperformance, or alpha, just to break even with a simple index fund that might cost 0.04%. And just like in Buffett's bet, over the long run, that small handicap compounds into a massive disadvantage. It's a mathematical certainty. This isn't just one 10-year bet either. This is a pattern that has been proven over and over again by decades of data. One of the most respected scorekeepers in this debate is S&P Dow Jones Indices. Every 6 months, they release a report called the SPIVA scorecard, which stands for S&P Indices versus Active. It's a dry academic-sounding name for what is essentially a report card on active management. And every year, active managers flunk in spectacular fashion. The data is damning. Over the last 15 years, more than 92% of all U.S. large-cap active fund managers failed to beat their benchmark, the S&P 500. Let me repeat that. 9 out of 10 professionals, whose entire job is to beat the market, failed to do so over a decade and a half. And it's not just in large U.S. stocks. The results are the same across almost every category you can imagine. Mid-cap stocks, small-cap stocks, international stocks, even bond funds. The longer the time frame, the worse the active managers perform. The math is inescapable. This brings up a crucial concept for any investor to understand: survivorship bias. We hear about the handful of star managers who do beat the market for a few years. They get profiled in magazines, they go on TV, and their funds attract billions of dollars from investors chasing those hot returns. But what we don't see are the hundreds of funds that failed along the way. Funds that performed so poorly they were quietly shut down or merged into other funds to hide their terrible track record. The financial industry is very good at burying its failures. So when we look at the funds that are available to us today, we are only looking at the survivors. This creates a powerful illusion that beating the market is much more common than it actually is. The data, from Buffett's bet to the SPIVA reports, tells us the truth. The single greatest predictor of a fund's future success isn't the manager's past performance, their IQ, or the university they attended. It's their cost. The lower the fees, the higher the probability of a better outcome for you, the investor. Short-term strategies, by their very nature, require active management, which in turn requires higher fees and more frequent trading, which generates more taxes. It is a system built on a foundation of costs that ultimately suffocates the very returns it promises to generate. The evidence seems overwhelming, almost ridiculously one-sided. So it begs an even bigger question. If the data is this clear, if the math is this simple, why do trillions of dollars still sit in high-cost, short-term, actively managed funds? Why do millions of intelligent, well-meaning people continue to bet against the odds? Is it just a failure of education? Or is there something deeper at play? It's because the choice between a short-term active fund and a long-term passive one isn't just a financial decision. It's a psychological battle. And it's a battle we are hardwired to lose. The modern stock market is a relatively new invention, a complex system of abstract numbers and long-term probabilities. But the human brain we use to navigate it? That's the same piece of hardware our ancestors used to survive on the savannah. It's an ancient operating system running brand new software, and it's full of glitches. Our brains are not optimized for patient, long-term wealth creation. They are optimized for immediate survival. For millennia, the most important question was, what's going to kill me or feed me in the next 5 minutes? A rustle in the grass wasn't a data point to be analyzed in a diversified portfolio of potential threats. It was a signal to run or to fight. Inaction meant death. This instinct, this deep-seated need to do something in the face of uncertainty, is called action bias. And it is the lifeblood of the high-cost, short-term fund industry. When the market drops, our savannah brain screams, "Danger! The tribe is starving. Do something. Sell." When a stock is soaring, it yells, "Opportunity! There's a fruit tree no one else has seen." Get it now before it's gone. Buy. The idea of sitting still, of weathering the storm or letting the opportunity pass because it doesn't fit a long-term plan, feels deeply fundamentally wrong. Feels like negligence. So we crave action. We want to feel in control. A short-term, actively managed fund is the perfect product to satisfy this craving. It sells the illusion of action. It whispers in your ear, don't just sit there. Be smart. Be nimble. While everyone else is passively riding the market down, our brilliant manager is actively selling, buying, and protecting your money. It transforms investing from a boring, passive act of waiting into an exciting, engaging activity. You're not just an investor. You're a strategist picking the right manager, the right horse for the race. You get to check the fund's performance daily, feeling the thrill of small wins. You're doing something. The fact that this something is statistically likely to cost you money in the long run is a detail easily drowned out by the siren song of action. This ties directly into another cognitive trap, the illusion of control. We fundamentally overestimate our ability to influence events. Think about when you're at a craps table in Vegas. People will often throw the dice softly when they want a low number and hard when they want a high one, as if the force of their throw has any bearing on the outcome of a random roll. It's nonsensical, but it gives them a feeling of control. Investing is the same. Picking a star fund manager, timing the market, jumping on a hot trend, it all makes us feel like we're the pilot, not just a passenger. The marketing for these funds is pure genius because it doesn't sell you a financial product. It sells you a feeling of empowerment. The ads are filled with images of confident, decisive people at the helm of their financial destiny. The message is clear. Passive investing is for followers. Active investing is for leaders. For winners. And who doesn't want to be a winner? We believe we can pick the right fund, the one that will beat the odds, for the same reason that 80% of drivers believe they are above average. It's simple human overconfidence. We see the statistic that 90% of fund managers fail to beat the market, and our brain's immediate subconscious response is, yeah, but my guy is in the other 10%. But perhaps the most powerful psychological force at play is the narrative fallacy. As humans, we are not wired to understand spreadsheets and data. We are wired to understand stories. A simple, compelling story will always be more persuasive than a mountain of statistical evidence. What's the story of a long-term low-cost index fund? It's this. Buy a tiny piece of everything, then wait for 30 years. It will probably go up. It will be boring. It's a terrible story. It's like telling someone the way to get in shape is to eat a balanced diet and exercise moderately for the rest of their life. It's true, but it's not exciting. Now, what's the story of a short-term, actively managed fund? It's a Hollywood blockbuster. Meet Sarah, our fund manager, a math prodigy from MIT who left a 7-figure job at Goldman Sachs because she wanted to help real people. She developed a proprietary algorithm, a secret sauce, that identifies undervalued companies just before they take off. She works 100 hours a week, living and breathing the market, all for you. This isn't just a fund. It's a crusade against the lazy establishment. Which story do you want to invest in? Which story makes you feel like you're part of something special? The data is irrelevant. We don't buy the fund, we buy the story. We fall in love with the hero fund manager, the David fighting the Goliath of the market. We read articles about them, watch them on TV, and we feel a personal connection. So when the fund underperforms for a year, or even 3, we don't look at the data and sell. We look at the story and say, she's just in a slump. A hero always faces adversity before the final triumph. We hold on, paying our high fees because we're emotionally invested in the narrative. And this entire ecosystem of psychological biases is fed and amplified by a multi-billion-dollar machine, the financial media. Cable news channels, websites, and magazines don't exist to give you sound, long-term financial advice. They exist to sell advertising. And you know what sells advertising? Drama, urgency, action. The headline expert recommends sticking to your long-term plan gets 0 clicks. The headline, the death cross appears. Is a market crash imminent? 5 stocks to sell now. Keeps you glued to the screen through the next commercial break. The entire industry is designed to make you feel like you need to be constantly doing something, reacting to every piece of news, every analyst upgrade or downgrade. They parade a succession of experts and fund managers in front of the camera, all with compelling stories and hot picks. They create a 24/7 casino where the game never stops, and if you're not playing, you're losing. This constant noise validates our action bias, fuels our illusion of control, and provides an endless stream of new stories to buy into. It's the perfect storm, a powerful conspiracy between our own flawed psychology and an industry that has learned to exploit it perfectly. It's not about a failure of education. You can show someone all the charts, all the studies, all the evidence. But you're not fighting an information deficit. You're fighting against millennia of evolutionary instinct and a lifetime of narrative conditioning. So if our own minds and the world around us are so perfectly aligned to push us toward these short-term, high-cost decisions, how does anyone ever break free? How do you build a fortress for your wealth that's strong enough to protect it from the most dangerous enemy of all, yourself? The answer lies not in willpower but in structure. It's found not in fighting our impulses head-on, but in making it impossible for those impulses to ever take the wheel. The ancient Greeks had a story for this. It's the story of Ulysses, a brilliant strategist sailing home from the Trojan War. His journey forces him to pass the island of the Sirens, mythical creatures whose song was so enchanting, so irresistible, that no sailor who heard it could stop himself from steering his ship directly into the rocks, to his death. Every sailor before him had tried to resist through sheer force of will, and every single one had failed. The song was just too powerful. But Ulysses was different. He understood a fundamental truth about human nature. You cannot trust yourself when temptation is at its peak. Your rational mind will be hijacked. So he didn't prepare to fight the song. He prepared to make the fight irrelevant. He ordered his men to plug their ears with beeswax, so they couldn't hear a thing. Then he had them bind him tightly to the mainmast of the ship. He gave them one single non-negotiable order. No matter how much he begged, screamed, or pleaded, they were not to untie him until they were safely past the island. He wanted to hear the song, to experience it, but he knew he couldn't be trusted with control. And as they sailed past, the sirens began to sing. They sang of glory, of secret knowledge, of pleasures beyond imagination. And Ulysses went mad. He thrashed against the ropes, screaming at his men to change course, to untie him, promising them riches, threatening them with death. But his men, deaf to both the siren's song and their captain's crazed commands, simply kept rowing. They followed the original plan. And they sailed right past the danger, with Ulysses surviving to tell the tale, the only man to have ever heard the siren's song and lived. This ancient story is the single greatest blueprint for building long-term wealth in the modern world. Because every single day, you and I sail past the island of the sirens. Their song isn't sung by mythical creatures. It's blasted at us from our phones, our TVs, our news feeds. It's the song of the hot stock tip that promises to double your money overnight. It's the panicked headline screaming about a market crash that insists you must sell everything right now. It's the whisper of a new crypto coin that's going to the moon. It's the story your coworker tells about how they timed the market perfectly and made a killing. The siren song is the anthem of short-term thinking. It's intoxicating, it's alluring, and it preys on our deepest instincts of fear and greed. And trying to resist it with willpower alone is a fool's errand. You might win for a day, a week, a month, but for the 20, 30, or 40 years it takes to build real wealth, your willpower will eventually break. So you have to do what Ulysses did. You have to build a system that protects you from yourself. You have to lash yourself to the mast. In investing, the mast is your long-term strategy. It is your unwavering commitment to a small number of broadly diversified, low-cost mutual funds or index funds. It's not a hot tech stock. It's not a speculative venture. It is the strong, solid, boring core of your financial ship. Choosing this mast is the first critical decision. You don't tie yourself to a flimsy piece of driftwood. You choose something built to withstand a storm. This is why the choice between a short-term, high-fee, actively managed fund and a long-term, low-cost, passive index fund is so critical. One is a lottery ticket, the other is a mast. But just having a mast isn't enough. You have to bind yourself to it. The ropes are automation. This is the most powerful financial tool that almost no one treats with the reverence it deserves. Automation is you, in a moment of cold, calculating rationality, making a binding contract with your future self. It is the act of setting up an automatic transfer from your checking account into your investment account, every week, every 2 weeks, every month without fail. This single action does two miraculous things. First, it completely removes emotion and decision-making from the most important part of investing, the actual act of buying. You no longer have to ask yourself, is now a good time to invest? The market is up? You invest. The market is down? You invest. The news is terrifying? You invest. The news is euphoric? You invest. You are the deaf sailor, rowing on a predetermined course, immune to the madness-inducing song of the daily market. You've made the decision once and the system executes it for you forever. The second miracle is even more profound. This strategy, often called dollar-cost averaging, weaponizes the very thing that short-term thinkers fear most: volatility. When the market panics and prices drop, your fixed automatic investment now buys more shares than it did the month before. When the market gets euphoric and prices are high, that same fixed amount buys fewer shares. Without any active thought, your automated system is naturally, instinctively buying low and selling high in miniature, over and over again for decades. It turns the market's manic depressive swings from a source of terror into a long-term advantage. The sirens are screaming that the sky is falling, and your system is calmly buying up assets at a discount. This is the fortress. The walls are not made of complex algorithms or secret knowledge. The walls are made of consistency. The moat is not filled with exotic derivatives. The moat is filled with automation. You are building a system where the default action is the correct action, where inaction and discipline lead to wealth, and frantic activity leads to ruin. Think about the sheer psychological relief this provides. The entire multi-trillion-dollar financial media industry is built on the premise that you need to do something, that you need to react, that if you just had the right information at the right time, you could outsmart everyone else. Ulysses knew this was a lie. The secret wasn't in having better information, it was in recognizing that the information itself was the poison. His solution was to make himself powerless. And that is the great paradox of successful long-term investing. Your greatest moments of genius will not be the brilliant trade you made, but the hundreds of stupid trades you didn't make. Your success will be defined not by your action, but by your disciplined, systematic, automated inaction. You lash yourself to the mast of a simple, proven strategy, and then you let the crew, your automated contributions, do the rowing. This sounds simple, sounds boring, and it is supposed to be. The siren song is exciting. Building wealth isn't. Wealth isn't a lightning strike. It's the slow, silent, inexorable pressure of a glacier carving a valley. It's the almost invisible growth of a mighty oak tree. By automating your contributions into a long-term, low-cost mutual fund, you are planting that acorn. You are setting that glacier in motion. But tying yourself to the mast is just the beginning of the journey. The ship is now on the right course, and you're protected from your own worst impulses. But the journey is long, and there are other dangers ahead. There are storms that will test the strength of the mast itself, and periods of dead calm that will test your patience. What happens when a real storm hits? A true gut-wrenching market crash that lasts not for a week, but for a year or more. What do you do when the ropes start to feel less like a tool for salvation and more like a straitjacket, and you see other ships seemingly finding shortcuts to treasure islands? That is the single most important question in long-term investing, because it's not a question of numbers or charts anymore. It's a question of your own human spirit. It's a battle fought not on a trading floor, but in the quiet, dark corners of your own mind at 3 in the morning when you're staring at the ceiling, watching your life savings seemingly evaporate. Let's be brutally honest. The feeling is terror. It's a specific kind of financial vertigo, where the solid ground you thought you were standing on turns to quicksand. Every headline, every news report, every panic post from a stranger online becomes a voice in a deafening chorus screaming, "Sell, sell, sell. Get out while you still can." And you, lashed to the mast of your long-term strategy, can only watch. The ropes of your automatic investments, your buy and hold philosophy, suddenly feel like they're choking you. This is the moment where the vast majority of wealth is either preserved and multiplied, or utterly destroyed. It all comes down to understanding what's really happening. Those other ships, the ones zipping around and finding shortcuts, are often mirages. They are the day traders, the meme stock chasers, the people who believe they can outsmart the storm. For every one who finds a treasure island, 99 others crash upon unseen rocks, their ships splintered and their fortunes lost to the depths. They are chasing the illusion of action, because doing something, even the wrong thing, feels better than doing nothing. Our brains are wired for it. We see a threat, we run. We see a fire, we put it out. We see our portfolio bleeding red, and our every instinct screams, "Stop the bleeding." But a long-term investment portfolio isn't a wounded animal. It's an engine. And during a market crash, that engine is simply going through extreme turbulence. The worst possible thing you can do is panic and start tearing out wires and ripping out parts. The pilot's job is to trust the instruments, trust the engineering of the plane, and fly through the storm. Your job is to trust the engineering of your financial plan. Now let's think about the short-term fund in this scenario. It's the ship that, at the first sign of dark clouds, sailed back to the nearest, safest harbor and dropped anchor. It's not losing. It's sitting there, capital preserved, safe and sound. The captain is sleeping soundly, no terror, no vertigo. And from the shore they can watch your ship get battered by the waves and think, thank goodness that isn't me. They avoided the pain. They avoided the stress. But here's the critical part. They also avoided the journey. A ship in harbor is safe, but that is not what ships are built for. The storm will pass. And when the skies clear, their ship is still in the harbor, while yours, though battered and bruised, is now halfway to its destination with the wind at its back. The short-term fund's greatest strength, its stability, becomes its greatest weakness if it causes you to miss the inevitable recovery and the powerful bull market that almost always follows a major crash. This brings us back to you on your ship, tied to the mast. It's time to reframe what those ropes really are. They are not a straitjacket. They are a tool of discipline, a pre-commitment you made to your future self. You, in a moment of calm, rational thinking, knew this storm would come. You knew your future self would be panicked, emotional, and tempted to make a terrible decision. So you tied yourself to the mast. You are not a prisoner. You are Ulysses from the ancient myths. Ulysses knew he would be sailing past the island of the Sirens, whose songs were so beautiful, so enchanting, that they lured sailors to their deaths, crashing their ships on the rocks. No man could resist. So what did Ulysses do? He ordered his men to plug their ears with beeswax and to tie him, Ulysses, securely to the ship's mast. He told them that no matter how much he begged, screamed, or pleaded to be untied as they passed the island, they were to ignore him and even tie him tighter. The siren song is the panic in the market. It's the get-rich-quick crypto scheme that suddenly looks like a lifeboat. It's the talking head on TV promising a secret stock that's immune to the crash. It is the overwhelming, all-consuming temptation to do something. Your long-term mutual fund strategy, the automatic investments, the commitment to not sell, is you tying yourself to the mast so you can sail safely through the most dangerous part of the journey. But it gets even better. Because you're not just passively enduring the storm. A true long-term investor sees a market crash for what it really is, the single greatest sale of our lifetime. Think about it. If your favorite store announced a 30% off everything sale, would you run out of the store screaming? No, you'd run in and buy as much as you could. Every blue-chip company, every innovative tech firm, every solid, dividend-paying stalwart in your mutual fund is suddenly on sale. Their fundamental value as a business hasn't necessarily changed, but their stock price, the sticker price, has been slashed. This is where the magic of dollar-cost averaging ignites. That same $100 automatic investment you made last month when the market was high might have bought you, say, 2 shares of your fund. This month, in the middle of the crash, that same $100 might buy you 3 shares. Or 4. You are accumulating more ownership, more pieces of these great American and global companies, for the exact same cost. You are not just weathering the storm. You are actively loading your ship with discounted cargo that will be immensely valuable when you reach the other side. Every share you buy in a downturn is a vote of confidence in the future. It's an act of defiance against fear. It's turning panic into power. Let's look at the COVID crash in March 2020. The market fell over 30% in a matter of weeks. It was terrifying. Felt like the end of the world. Imagine 2 investors. Investor A panics. They see their 401k balance plummet, and they sell everything, moving to cash. They stop the bleeding. They feel a moment of relief. Investor B is tied to the mast. They feel the fear, but their automatic investments continue. They keep buying all the way down. Then the recovery begins. It's fast and furious. Investor A, the one in cash, is paralyzed. When is it safe to get back in? Have I missed the bottom? If I get in now, will it just crash again? They wait, and wait, and wait, trying to time the market perfectly, an impossible task. Meanwhile, Investor B, who never left, is carried upward by the recovery. Not only does their original investment recover its value, but all those extra shares they bought on sale are now rocketing up, supercharging their returns. By the end of 2020, just 9 months later, Investor B isn't just back to where they started. They are significantly wealthier than they were before the crash ever happened. Investor A is likely still in cash, having locked in their losses and missed one of the fastest market recoveries in history. One saw a crisis, the other an opportunity. This is the fundamental difference in mindset. A short-term fund is about avoiding risk. A long-term fund is about harnessing volatility. It's about understanding that on a long enough timeline, the trajectory of human innovation and economic growth is up and to the right, but the path is never, ever a straight line. It's a jagged, terrifying, thrilling climb up the side of a mountain. The short-term fund keeps you at base camp, where it's safe. The long-term fund is the gear that gets you to the summit. So the choice isn't just about different financial products with different risk profiles. It's about choosing your philosophy. Are you building a fortress to protect what you have, or are you building a vessel to take you where you want to go? Both have their place. A fortress is useless if you have no treasure to protect, and a ship is useless if you have no destination. The ultimate secret, the key that unlocks true, lasting wealth, isn't about choosing one over the other. It's about understanding how to use them both. It's about knowing when to be in the harbor and when to be on the open sea. How do you build a fleet, not just a single ship? How do you construct a portfolio that gives you the safety of the short term and the explosive growth of the long term, all at the same time? The answer is, you stop thinking like a captain of a single ship, and you start thinking like an admiral of a fleet. Your financial life isn't one journey. It's a series of simultaneous voyages, each with a different destination and a different timeline. And a wise admiral would never use the same vessel for every single mission. You wouldn't send a nimble speedboat to haul 1,000,000 tons of cargo across the Pacific, and you wouldn't use a massive supertanker to go fishing just off the coast. Each goal requires a purpose-built ship. This is how you build your portfolio. This is how you create a fleet that has both safety and speed, stability and power. Let's start in the harbor. This is your short-term fleet. These are your goals that are anywhere from tomorrow to about 3 years away. This is your emergency fund, the money for a down payment on a house next year, the savings for that big vacation you've been planning. The ships in this fleet are not designed for speed. They are designed for one thing and one thing only: absolute, unshakable stability. They are the sturdy tugboats, the heavy-bottomed barges. They are your money market mutual funds, your ultra-short-term bond funds. Their job is to be there, fully intact when you need them. You are not trying to get rich with this money. You are trying to stay secure with this money. The greatest risk to this fleet isn't a market crash. It's inflation slowly taking small bites out of your cash. That's why we put it in these types of funds, to earn just a little bit more than a savings account, to fend off the barnacles of inflation while it waits safely in port, ready to be deployed at a moment's notice. An admiral who neglects their harbor fleet is an admiral who can be sunk by a single, unexpected storm. Now let's look just beyond the breakwater. This is your coastal fleet, for your midterm goals. These are the destinations that are maybe 4 to 10 years out. Paying for a child's college education when they're in middle school. Saving up to start a business in 5 years. A major home renovation. The vessels in this fleet are more versatile. They are your cruisers and your frigates. They have more power than the tugboats, but they're still built to handle the choppy, unpredictable waters of the medium term. This is where you might find your balanced mutual funds, the ones that hold a mix, maybe 60% stocks and 40% bonds. They give you a taste of the market's growth potential. But the bond portion acts like a deep keel, providing stability when the waves get rough. You're taking on more risk than the harbor fleet for sure, but you're doing it because you have a bit more time on your side. Time is the ultimate shock absorber in investing. A 5 or 7 year timeline gives you enough runway to recover from a potential market downturn without having to sell at a loss. Your coastal fleet is all about calculated risks for meaningful rewards, bridging the gap between immediate safety and far-off ambition. And then, there is the open ocean, the deep blue. This is your long-term fleet. This is the main battle group, the tip of the spear. This is for your retirement in 20, 30, or even 40 years. This is for building true generational wealth. The goals so far on the horizon, they are just a glimmer. The ships in this fleet are the largest, most powerful vessels you have. They are your aircraft carriers, your battleships. They are your broad market stock index funds, your growth mutual funds. These ships are built for one purpose: to harness the immense, unstoppable power of the global economic engine over decades. Now let's be perfectly clear. Out on the open ocean, there will be storms. There will be terrifying, gut-wrenching hurricanes we call bear markets and recessions. Waves the size of skyscrapers will crash over the deck. At times, you will lose sight of the horizon entirely. Many captains panic in these storms. They abandon their mighty ships, thinking they can swim for shore. But the admiral knows better. The admiral knows that these great vessels were built for these storms. Their very design accounts for the volatility of the open ocean. And the admiral knows that over the long journey of decades, these storms are temporary. The powerful underlying current of human ingenuity, innovation, and progress will always push these ships forward. The explosive growth doesn't come from dodging the storms. It comes from having a vessel strong enough to endure them and sail on. The fuel for this fleet is time and compound interest, the most powerful force in the financial universe. So you see, the debate was never really short-term versus long-term. It was a false choice. The real question is one of allocation. It's about being a savvy admiral. Your job is to stand on the bridge, look at your map of life, and assign the right ships to the right missions. Your emergency fund? That's a harbor mission. Pure safety. Your dream of buying a home in 2 years? Harbor mission. Capital preservation is key. Your kids' college fund when they're 12? That's a coastal cruiser. You want some growth but also some stability as the goal gets closer. Your retirement account at age 30? That is a blue water vessel. Full speed ahead. You have decades of ocean to cross, and you need the most powerful engine you can get. And your role as the admiral isn't to frantically steer the ships every day. You don't check the weather report every 5 minutes and change course. That leads to chaos. Instead, you set the destinations with care. You choose the right vessels for the journey, and then you trust the design. You implement systems like automatic monthly investments, which is like setting the navigation computer to autopilot. It forces you to keep provisioning your ships, whether the seas are calm or stormy, a strategy we know as dollar cost averaging. And maybe once a year, you, the admiral, review the fleet's position. You check in. Is the coastal fleet getting too far from shore? Maybe it's time to bring it in a little, shifting to more conservative funds as that college tuition bill gets closer. Is the blue water fleet still on course for your retirement destination? This calm, disciplined review is how you manage your fleet. Not with panic, but with purpose. This is the secret. It's not about finding the one perfect mutual fund. It's about building a perfect fleet for you. A fleet that mirrors your life, your dreams, your timeline. One that gives you the confidence to know your immediate needs are safe in the harbor, while your greatest ambitions are sailing powerfully toward the horizon. The journey of 1,000 miles begins with a single step. And for an admiral, that first step is to draw the map. So before you do anything else, take out a piece of paper or open a new document on your computer, and simply write down your destinations. Write down your goals, and beside each one, write down the timeline. That's it. That's the beginning of your map. Once you know where you're going, choosing the right ships for the journey becomes one of the clearest, most empowering decisions you will ever make. You are the admiral. This is your fleet. And the open ocean is waiting.